What's happening, options traders? Good morning, everyone. And in the last video, I talked about selling straddles against shares of stock and what that created as an alternative way of looking at a covered call. Well, if we can sell straddles, we should be able to sell strangles. After all, they're virtually the same strategy. They're just separated by strikes. But what would happen if you sold strangles against shares of stock? I like to show this for a couple of reasons, but I think one of the most important is to show traders how to generate new ideas. So even if you're just sticking with covered calls, a very basic strategy, you can still learn a lot by understanding your strategies, your profit and loss diagrams. You'll be able to come up with new ways to create the same profit and loss diagrams, but maybe with more advantages. And selling strangles against shares of stock is a perfect example. So what is this one all about and what's it going to do for you? Well, as always, to make a comparison, let's start with the covered call. Remember, this strategy means you're going to buy 100 shares and you will sell one call, perhaps the 105 call. But it's always in a 1-to-1 ratio. Buy 200 shares, you could sell 2 calls. Buy 1,000 shares, you could sell 10, and so on. But the idea is that you are selling calls against your shares. And what that does is it creates the obligation to sell your shares for the strike price. Now, to be clear, it's really a potential obligation. It's not a guarantee because it all depends on if the buyer of that call decides to exercise. But you just need to understand that it is a possibility that you're going to end up selling those shares for the strike. So that's one way to approach a covered call, and that's how most people do it. They pick a strike, they sell all of their calls at the same strike. Well, that's not always the best idea. What if the stock rallies? Maybe we want to capture different skews. There's a lot of different reasons why we might not want to focus on a single strike. And so there's another strategy that you might hear of, sometimes called a double covered call. What is this? Same idea. But what you'll do here is perhaps buy 200 shares, let's say trading for $100, and you might sell the 105 call, and then you might sell the 110 call. So notice that we are selling 2 calls, and we're able to do that because we purchased 200 shares. So we don't have any naked calls hanging out there, and in a way it's a covered call, conceptually it's the same, but we're going to alter this profit and loss diagram. So what's it going to do for us? Well, first of all, by selling this higher strike call, the 110, you're going to receive less money overall than had you sold 2 of the 105s. Why? Higher strike calls have to cost less money, all things being equal. So by selling the 110, you're receiving a little less money, but you're also going to increase the potential profits. It's, as always, a trade-off in risk and reward. So if you buy the 200 shares, sell the 105 call, and sell the 110 call, this is what your risk graph looks like. Notice that we have 2 bends that I always talk about. You'll always get a bend at your strikes. So I have one right here at 105. That's the first call that we sold. And I've got another here at 110. So notice that by selling these 2 different strikes, we've created this little angled portion in our risk graph, and that's usually not there for a typical covered call. So for comparison, if we had sold 2 of the 105 calls, we would look like this. We would only have 1 bend at the 105 strike. So if we overlay the 2 graphs, now you can see the differences. By using this double covered call, yes, you're going to increase the profit potential, but you're also going to reduce the downside hedge. So it's just a trade-off in risk and reward. And it's up to the traders to figure out when these are appropriate times and when they're not. And this is where your technicals can come in. Are we getting near a resistance or near a support? And depending on what's happening, we might actually want to switch between these 2 strategies. Well, regardless of your reason, if you like this double covered call, the one in red, how else could you do it? Well, this is where you could sell a strangle. Perhaps you buy 100 shares, trading for $100, but you sell the 105 put and you sell the 110 call. That is being short the 105, 110 Strangle. So why might we do this? Well, there's a lot of reasons why we might choose selling the Strangle versus the double covered call. The primary reason is that it's depending on the skews that you might receive more money. Might end up with a mathematical edge in your favor. And you'll also spend less money on the position. So if we did this strategy right here, buying 100 shares, selling the 105 put and the 110 call, what do we get? Exactly what we got before. Absolutely identical. The difference is, in this graph, this little angled portion is 100 deltas coming from our 100 shares. Remember when we did the double covered call, we had to buy 200 shares. So how are we getting these steeper slopes down here? Well, the 200 deltas down here are coming from the 100 shares, but they're also coming from the short put. So this is why you're not having to spend as much money on the position. You only need to buy 100 shares and then sell the put, and the short put creates the extra 100 deltas. Now, yes, you will have a margin requirement on that short put. It's usually going to be about 20% for an index or about 25% for an individual stock. But it's certainly, in either case, better than spending 100% for the shares. So why might we sell this Strangle? Well, again, traders may capture better skews. That's probably the primary reason. But another one is, often overlooked, is that you're capturing average skews. This is a very professional trading technique where we're going to, sometimes called a laddering strategy. We might sell a 1 week option, a 2 week, a 3, and a 4. And then when the 1 week expires, we sell that as the new 4 week. So we've always got these in our stable, but they're just constantly being rotated because we never know which month is going to have maybe a pop in the skews. Well, by doing this and casting a wider net, you can now capture the average skews. And once again, that can create mathematical edges. A little bit like a casino in Las Vegas where you've got a mathematical edge working in your favor. And that's because if you're selling options that have a favorable skew, at least favorable to the seller, that's working to your advantage. And you might get that by selling the put, but not by selling the calls. And as I also mentioned, it makes you more cash efficient. Rather than having to buy 200 shares and sell 2 calls, you buy 100 shares and sell the Strangle, and you are in fact doing a double covered call. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.